Well, greetings. I trust that everybody has had a really good holiday season and that as we're getting ready to um, get a new year started, that everybody is really ready to take a quick dive into some admittedly rather shocking information. Um, this is the 2026 edition of the What Buyers Are Looking For report. This is actually going to be the final report because um, over the course of um, the final months of 2025, what began to become apparent was a better report that we will be starting in 2027 is a annual state of exit planning report. And what this is going to do is it's going to go into all of the details as far as really what you can expect when it comes to exit planning. And today, even though we're going to be getting covering a lot of the stuff that you can expect to find um, in the current um, state of affairs when it comes to exit planning. The 2027 edition is going to be uh, structured a bit differently. So, without any further ado, let me thank you all for deciding to join us today. And let's just do a quick dive into this information, which I honestly feel a lot of it was a bit on the surprising side as we see the M&A space develop and morph. I mean, obviously, it's improved from where it was a few years ago, but you know, the uh, the approach that people are taking is a bit different. So, with that having been said, let's kind of dive in to really the value gap reality now that we've kind of laid the groundwork, and that is companies that are planning about 3 to 5 years ahead, they're almost assured to receive 20 to 40% higher valuations. Premium multiples that businesses can command, especially if they're well built and well designed and they've done thorough planning and work, it'll be anywhere from 7.2 to 8.0 EBITDA multiples. And, founder dependent operations, it'll be in the 4.0 to 5.5 multiple range. And one thing I should mention is these are averages. Some industries are going to be substantially higher than others, especially the really, really hot ones. So the reality is these are averages, and don't be surprised if when you get down to your specific industry, there's going to be some variation. Some of it, you may be, most industries will be closer to the average. Some, will probably be on the fringes. So what creates this gap? Well, what we're going to be taking a look at today are the things that really do go a long way in creating this value gap that will cause some businesses to go at a premium while others, they're basically taking a major haircut. So let's take a current dive now that we've looked at the value gap into the current market landscape. Now, these are looking at some numbers from recent years. As you can see, 2024, the middle market deal value was right around $374.1 billion. Which that was actually a 17% increase year over year. Obviously, we're going to be getting 2025 numbers here soon. The dry powder that private equity firms have available, it's 2.6 trillion plus. So there's a lot of capital out there and a lot of opportunity for um, M&A transactions. But here is where things get really interesting. Private equity firms evaluate typically around 80 deals before making one investment. That means for every deal that they make an offer on, they've reviewed 80 other deals. Now, obviously, since we have more private equity firms in this country than we have McDonald's restaurants, um, you know, that's not necessarily saying like, okay, the market demand is such that it's like, private equity is not investing. Thankfully, just it's a numbers game, and because of the sheer number of private equity companies, um, the reality is they're looking at a lot of deals before they're making an investment. So, that's kind of where things stand. And really, the reality is like, okay, don't be surprised to be viewed by a lot of firms before you get an offer and just one offer. Now, obviously, I am not a big fan of private equity. I understand they exist for a reason. I'm more of a of family offices and their investment, but really, that's just giving you an idea about just how much things have shifted, and like private equity firms are being careful and they're being almost becoming strategic in their investments. So here are the types of buyers that really I just want to kind of lay the groundwork and just clarify really the buyers that we're looking at. Private equity firms, which sometimes we would label these as financial buyers. They're looking for high growth businesses with scalable operations and strong management teams. While they're looking for that, at the same time, they are willing to go in and basically rebuild the business as needed, which is why they don't mind going to founder dependent businesses. And that's why when it comes to any unsolicited offers you receive from a private equity firm, I would strongly encourage you to evaluate it, just because of the fact that almost always they're going to be much lower. Because again, think about it. If private equity firms are reviewing 80 deals before making an offer, it means they've done their homework and they know roughly what your business is worth right now. Strategic buyers, these are buyers who are looking for synergistic opportunities that enhance their existing business model or, expand their market reach. And most likely it could be like, for example, they're looking to add a complementary product. And then family offices, which honestly, my preference is to go with family offices if we could, just because of their overall philosophy is they like to invest with a long-term horizon, focusing on steady returns and capital preservation. So really, they're wanting to invest in something that is well built. And they're not. I mean, they're willing to invest in it, but at the same time, it's not like private equity where they're going to just completely gut everything. Um, so that kind of lays the groundwork, just in case. Again, I'm just wanting to make sure that everybody is familiar with this terminology. I know some people who are listening to this are thinking, okay, well, yeah, I know this. Why are you telling me this? Well, I just want to make sure that everybody who's watching this report, who maybe not be as familiar with the M&A space, is able to really get a good grounding with it. Okay, so having said that, let's take a look at the types of search funds that are out there as well. Obviously SBA has constraints. Um, you know, you have loan limitations. So um, and the reality is, most SBA, we may actually come to this. Your typical SBA loan is going to cap out at $5 million, which I know to some people that may think, wow, that's a lot. But if you're a business that is doing 30 million in revenue, $5 million loan for the SBA, um, it's probably not going to go that far. And also, funds, they'll have restricted capital sources. So you could have some challenges competing in the market, and search funds can be higher risk, just because they have increased risk profiles, and it's going to influence potential returns. Okay, so really the one thing that we want to get here now is the industry specific multiples. This is key. And again, some of these are these are kind of like the averages. But what I want to make sure is everybody understands what I said earlier about the fact that there's a wide range in multiples. Because you see here, with manufacturing, healthcare, and technology, um, this is just where things stand. Healthcare, obviously, these companies are at a premium. If you're a healthcare provider or somewhere in the healthcare industry, and you have things well built, well, you can see you can do really well. Technology and SaaS companies, which again, the tech sector is hot, and really, um, it obviously, there's a lot of talk about an AI bubble, so there are some concerns that, like, with some of these AI valuations. I know that AI valuations were much higher, and the data that I'm using, obviously, it's for 2024. It's not 2025 necessarily. I would not be surprised if when we do this presentation next year that we see this much higher. But the reality is, as we head into 26, my suspicion is there's going to be a lot of tempering with the multiples with tech and SaaS. And then manufacturing, those multiples, those tend to range from 6.1 to 6.9. So if you have a manufacturing company, obviously there's a lot of value to be found with what you're offering. Okay, so now that we have taken a look at this, here are the financial metrics that are really going to be impacting business valuations and growth. First of all, we need to focus on sustainable profit generation. If you're consistently generating revenue and it's predictable, everything it's become rather predictable what you're going to get. That's going to be considered a safe investment. If you have precision in financial reporting, in other words, if you're consistently closing the books out every month, having quarterly reports, you have financial modeling, and in short, you have very thorough, very, very well developed, mature reporting, that is going to really help you out there with your financial metrics. And obviously, a diversified customer base, we'll take a look at this in a little bit, but customer concentration. If you have one customer who is, let's say, for example, making up 50% of your income, people are going to walk from that because they're going to look and they're saying, okay, your base is not diversified and you're too risky. And then long-term contractual agreements for revenue stability. Obviously, MRR and ARR are key, but if you're able to say you're able to point at multi-year contracts, or even contracts that renew annually that have a history of being automatically renewed, those are going to have impacts. Now, the overall, like in the middle of this diagram, you'll see basically the overlap where all of these things work together. If you have all four of those things, the influence on overall business attractiveness is going to be substantial. People are going to look and go, okay, we like this. And then, this is also critical for potential buyer evaluations. If you have all of these and they're in order, your financial metrics are going to really look good. So now what we want to do is we want to take a look at really the technology requirements for business exit planning. And obviously, when it comes to key factors by revenue size, this is very important to keep in consideration. We need to have cloud-based solutions for scalability. I know some businesses out there still prefer desktop, which, I understand why the owner feels more comfortable with desktop apps. But the reality is, if you want to have a business that is ready to take off and scale in the 21st century, cloud-based operations are an absolute must. Cybersecurity measures need to be in place to protect data. These are not necessarily very expensive solutions, but the reality is because of the nature of hacking and the sophistication, and one thing I should mention here is just because you think, oh, it won't happen to me, that's one of the least safe assumptions that you can make. You might think I'm small potatoes. Well, here's the reality. If somebody hacks you and they demand with a ransomware attack, then here's the reality. You're not small potatoes. Somebody views you as a target. Having good customer relationship management systems in place is key. And, obviously we ran over the financial reporting tools for transparency, and then really automation tools, which, with the advent of AI, that's able to really help us with what I kind of refer to as secondary automation, where, primary automation is stuff that automatically happens. Secondary automation is stuff that, in my mind, is when you need to decide, okay, let's do this. So it doesn't happen automatically, but, with automation tools, whether it be AI or, say automatically happening, automation is key. And if you're able to have as much of that implemented as possible, it'll really help with your multiples. Okay, so let's take a moment and take a look at the cyber security risks. Um, you see the same statistic I'm looking at. 52% of companies uncover security risks only after the transaction is completed. So the reality is, you know, this goes both ways. We need to have rigorous security assessments and proactive measures. Just make sure that it could be something as simple as somebody being sent an invoice and says, hey, click on this, and boom, it was a ransomware attack. The reality is cybersecurity is big. It really has been massive since the mid 2000s, as hacking was really beginning to take off in many ways. But the reality is, if you want to be successful and be able to sell your business at a premium, you need to prioritize cybersecurity to protect all valuable assets. So again, cybersecurity, it is proving itself to be a big thing. Data maturity. This is something that is really, 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 really significant, and really, I almost want to spend a little bit of time on this, and that is data maturity has become a critical factor in private equity evaluations. Now, 78% of PE investors are considering it among their top 3 priorities. This makes sense just because of the fact the better data that somebody has, the more informed the decision making is. And really, as you can see, a company's ability to manage, analyze, and leverage data can significantly influence its attractiveness to buyers. Now, again, one thing I really need to mention is with PE firms, again, 78% of PE investors, that comes out to right around 8 out of 10. It goes both ways. It's not like, okay, they're looking at a firm, they're like, okay, they're going to pass it up. Most PE firms, they're not going to look at it and say, okay, I'm not going to buy it. Your family offices, if things are not looking really exactly where they want them to be, then, there's a really good chance that you're not going to sell them. But with PE firms, what they're thinking is like, okay, if they don't have this, 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 and this, they're thinking, okay, I'm going to make an offer here at a discount, knowing that I'm going to need to go back in and do that. So that is really one thing that, I may keep coming back to and harping on it, but it is really important to realize that a private equity firm is never going to go, oh, we're not going to buy just because we don't like this investment. What they're going to do is they're probably going to go like, okay, well, we see this, we see they don't have this, we're going to need to put this in. So when it comes time to making an offer, we're going to give them a substantially smaller offer. Now, founder dependency, this is the area where deals go to die. And, if probably the area that, if you're receiving deals from a PE firm, they realize, okay, this is where you're going to get your most substantial haircut. If a business is such that you cannot be there for, say, 90 days without it, if you cannot be there for at least 90 days and when you come back it is still functioning properly, if you cannot say that about it, well, then you have a business that is dependent on a founder. I remember one company I worked with, the business owner loved to go on vacations. It's like every few months will be just a week-long vacation, and then basically they'd return and the next 2 or 3 months was spent trying to catch up financially. So that just emphasizes that, like, if you're in a situation like that where you can't even be away for a week without having substantial recovery time and things falling apart, you don't have a sustainable business. And that's where, the 90-day test is crucial. Is, if we can get to the point where you can be away for 90 days and everything goes well, we're in great shape. Okay. Another area that is really crucial, and this is really, again, these are things, 2026. I know I talk about these in other webinars and things, but this is kind of where we are. 2026, things are not changing. If anything, they're continuing down the path they have been. Effective process documentation is absolutely crucial. And really establishing clear standards. That's and one thing I also should mention is following them. One of the fastest ways to get people to just completely disregard any institutional memory you might have if you're not going to follow your processes, policies, or procedures. If it's there, but it's like, okay, well, um, we're not actually going to do everything that's written, you know, what's the point of it then? So obviously, when it comes to documentation standards, we want to have them high when we want to make sure that they're followed down to the letter. But at the same time, we just got to make sure that we just simply document it and have something on file. And the benefit with this is going to enhance efficiency and productivity. It'll make you more profitable. And plus, again, it'll also make you more attractive to the buyer. Okay, so when it comes to the operational pillars that I work with, which really are foundational for getting a business to be well prepared, budget development controls, strategic planning, data and analytics, process policies and procedures documented, operations optimization, tech stack maturity, and then marketing plans. Those operational pillars, getting those in place is going to really help you in three areas. First off, you're going to have really strong governance, which is going to ensure not only compliance and strategic alliance, but it's also going to look very attractive to the buyer. Financials that are accurate and have robust metrics, transparency. A buyer is going to look at this and go, okay, yeah, this is absolutely key. And one area I know, one of the challenges with as time goes on, you begin to modify your approaches. I know on past webinars, I've said that I am not a stickler for making sure that everything is GAAP compliant with accounting. I have actually, as time has come on, I've decided, starting with this year, really, I'm going to adjust that. I now am a firm believer in trying to get everything as compliant with, GAAP accounting procedures. And I know that there is no one universal GAAP really accounting methodology. The goal is to make sure that everything is as close, really, to what everybody is perceived as possible. I know I forget. I know that there are two organizations out there that really give out the standards, and yeah, there are potential pitfalls with GAAP accounting, just because things aren't as standardized as we would like. But really, the goal is to make sure that the accounting is such that it is everything is as transparent as possible. And so I just to clarify that is my thinking having shifted. Now, the final area is operations. So we have streamlined operations that focus on efficiency and scalability. What this is going to do is this is going to be demonstrating readiness for growth to potential investors. So the reality is here in 2026, things are just continuing down the path that they were in 25 and 24. It's not like there have been any major pivots. If anything, it's clear that, where things were before are even more important today. Now, this is what's going to happen when you pursue the 3 to 5 year transformation. First of all, when it comes to making sure that you have your business ready for sale along the lines that we've looked at today, is we need to have a strong business infrastructure to support growth and operational effectiveness. And then once we have that foundation built, the next thing is we just need to develop the systems and processes to enhance efficiency and scalability. Now, before I go any further, what I should emphasize is that there's a very good chance that most businesses, when we look at this page, most businesses, it's actually just going to look more like Swiss cheese. They have a lot of what we have here, but in reality, what is going on is there are just holes. So there might be a hole in the foundation, or a hole in the infrastructure, or a hole in optimization or execution. really we'll, and so it's just filling in those gaps and just making sure things are smooth. Some of it, a lot of this may not exist. So really, the reality is every business is, its own unique individual, so to speak, and it's going to have individual needs. Optimization, that's where we're going to be refining things and just making them better. And then obviously execution, but that's the most important part, is once you've developed the strategies, you got to execute. So obviously we've taken a good look at some of the numbers and understanding the market. And what's important is understanding that when it comes to market timing, the reality is everybody is going to exit in a different market. And obviously, we're looking at market conditions today. The reality is, if you were to sign on with me this week or next week, okay, you're probably going to be exiting in between 2029 and 2031. And the reality is, the market conditions there are going to be substantially different than they are today. And obviously, the timing is going to impact valuation and buyer interest, that's going to be something that we're not necessarily going to be able to control. But that's why we need to be monitoring all these indicators, as well as making sure that we're getting everything as improved as possible. Because here's the reality: if you have a business that is valued very highly and is clearly an attractive purchase, it doesn't matter if you're in the deepest of recessions or you're at the peak of the greatest economic expansion. You are going to be able to confirm they command the highest multiples. So that's what's really important, is realizing, like, when it comes to market timing. And I'm glad that the slide was labeled this way, just because of the fact that when we think about market timing, the way most people think about market timing is like, okay, get out when the price is the highest. Well, what we need to be thinking about when it comes to market timing is we got to really understand how the market timing works. And the reality is, while we're not going to be able to control it, having our pulse on the way things are with the market, and not only that, but also just making sure that we understand that it's all about attractiveness. And if we have a well-built business, that's going to be what's going to command the highest multiples, not exiting at just the right time. Okay, so here are some key takeaways from everything that we've looked at. If you want to maximize your valuation, it's crucial to plan ahead. And really, the statistics show that companies that took the 3 to 5 years to prepare, kind of like along the lines of what we were looking at earlier, just a few minutes ago, they were achieving 20 to 40% higher valuations. And then, obviously, if we understand what the buyer expectations and industry multiples are, that's going to impact our outcomes. And that's really why, one of the important things when you get started is finding out what those multiples are, because it's all about managing expectations. And if you're able to manage expectations effectively and know what you can expect to get, you're going to be so well positioned. And then really, finally, making sure you have everything effectively documented and reducing founder dependency to nothing. So there's low dependency. Basically, you could spend your entire year traveling the world and the business functions well. Those are all key elements in preparing for a successful business exit. Okay, now what really needs to happen now, and by the way, I have available this the 2026 report, which goes into greater detail than I could in this webinar. But what needs to happen here is this is where there needs to be some self-assessment. And what this is going to do is this is going to allow business owners to reflect on readiness for exit planning. I would encourage you to take that report. I also have an exit planning tool suite. You could, go to my website or go to my LinkedIn page. You could contact me via email you have my email address, info@evanduke. You could ask, hey, could you send me your exit planning tool suite? And that'll give you 5 diagnostic tools for self-assessment to see where things stand. And what's going to be helpful is if you use those tools or you look at this report, is it'll enable you to engage in, self-assessment, and you'll be able to evaluate your company's growth potential, operational efficiency, and market positioning. And what needs to happen is you need to be willing to ask the right questions that can highlight strengths and areas for improvements. What is hard here is we've got to be willing to take a look at, the questions that make us uncomfortable. If we can do that, we will be in great shape. And what I'm going to encourage you is if you've been thinking about this, if you were thinking about this all the course of last year, what you need to do is you need to use this opportunity to gauge your preparedness and then just take a look at what buyers are seeking in 2026. There's a good chance, having looked at this, that the reality is if you're new to this, that, okay, you understand what people are looking for. There's a good chance that a lot of these numbers will vary. They're probably not going to change too much from year to year. But, what I'm going to do is I'm going to plant a bug in your ear is if you're 5 years out from exit and you're looking at this, now's the time to get a sense that, and as every year goes by, you'll get a chance to get more and more data points showing the direction that people are going. And that's why I would encourage anybody who watches this to consider seriously attending the annual state of exit planning webinars that will be starting next year, is because every year having these additional data points is going to help as you make your plans, just because you're going to get a clearer and clearer picture of what it's going to look like when you exit your business. So what are some next steps? Well, what you need to do is, first thing you need to do is you need to assess where your current position is. It's hard and may be uncomfortable just because of the fact that you're going to need to acknowledge some things that, are uncomfortable truths, but the sooner that that's acknowledged, the better you'll be. Once you've done that, then next thing you need to do is engage with advisors. Obviously, me as a fractional COO, my focus is on the business. What I would encourage you to also engage with is I would encourage you to engage with a wealth manager or financial advisor who would be able to develop personal strategies for you, which includes everything from determining how much money you need to retire to what you're going to do with your time. And then obviously, if you work with me, we will bring in an M&A advisor who will be able to talk and will be able to advise you when it comes to the sale process. So what's important is realizing that a lot of this is going to help you when it comes to developing and implementing changes. And what's going to happen is by cultivating relationships with potential buyers, it's going to position you for successful transition. And what's important is realizing the potential buyers, is because, a lot of these PE firms, which are, they're loving to invest and buy things. The reality is, if you understand, understand the thought process, get to know them better, what's going to happen is the better you understand it, the better position that you are going to be. So right now, what I would like to do is I would like to thank everybody who was able to attend this presentation. I will admit that this year's presentation is going to be significantly shorter than next year, partly because of the fact that, again, what we're looking at is we're going to be looking at a lot more intensive analytical information that we're going to be collecting on a monthly basis here. But really what my hope is that if you have any questions, you see there my mailing address, my business number, as well as my email address. I would strongly encourage you to just take the time right now, if you have any questions, to just please send me an email or a text message. So having said all of that, it's my hope that this information was able to really give you some clear thought processes, and that when the time comes, you are as well positioned as possible for a successful exit. So again, I wanted to thank you all for coming to this webinar, and it's my hope that this information, as well as the ensuing report, are helpful for everybody. Thank you all again for your time, and have a wonderful rest of your day.